As expected, another major central bank accelerated its rate cut schedule today. At the same time, the IMF downgraded its forecast for global growth, and those two things are very much related. The move from the Bank of Canada cutting rates by 50 basis points came in response to consumer price numbers that are now below their target and falling. Also, weakening in the labor market, particularly hiring, and especially hiring intentions that continue to get uglier and uglier. Where have we heard all this before? I pointed this out just recently. Canadian central bank policy rates mimic those in the US, or the other way around if you like. The Fed mimics the Bank of Canada. It doesn't really matter because national central banks are superfluous. In other words, if the Canadians are cutting more aggressively, then the Fed is going to be doing the same thing because both are going to be reacting to macroeconomic changes across the global economy, which is where the IMF comes into this. The IMF downgraded its global economic forecast for next year, and the organization has continuously lowered its projections going back to 2021 as the world continues to come in weaker than projected. The IMF, like most central banks, had expected that recovery, at least as they saw one, to continue well on into the future. And you can see that in their projections how they've been forced to change. What the IMF, the Bank of Canada, the Fed, the ECB, and all the rest of them have in common is that they're just hoping this downside of the supply shock just magically stabilizes in a disinflationary Goldilocks. However, they're also increasingly concerned and even nervous that won't happen. Therefore, the IMF downgrade and accelerating rate cuts all over the place, including Canada. Don't let this little Fed regret trend fool you. Policymakers here in the US are already late in the cycle, so they're following Canada and elsewhere to begin with. What the Canadians just said about their labor market sounds so familiar, this complete lack of hiring, because once again, they're all reacting to the same things in the global system. So the IMF and even central banks would love to declare victory here, but they know and they can see the signs that the system is slowing too far, that it's a very real risk, if not worse than a risk, of going beyond the Goldilocks disinflation as the downside of the supply shock continues. Worst of all, they're all expecting, their optimistic case is predicated on the effectiveness of rate cuts, which we know rate cuts don't do anything. So back to our old buddy up in Canada, Tiff Macklem, the head of the Bank of Canada. The latest projections from the Bank of Canada show that GDP they're expecting at 1.2% for this year, though that's optimistic. And of course, they show a pickup in growth next year because of rate cuts. As Mr. Macklem himself said at his press conference today, we want to see growth strengthen. Today's interest rate decision should contribute to the pickup in demand. There it is. We took a bigger step today because inflation is now back to the 2% target. It's actually below the target, and we want to keep it close to the target. And that's really the point. As consumer prices go below the target, they know that this is the danger zone of bad disinflation, the kind that we saw way too much of in the 2010s. And it's associated with softening in the labor market. And so what the Bank of Canada is doing, like any other central bank around the world, and even the IMF to a certain extent, is saying that if we cut rates and do so more aggressively, it raises our chances of offsetting the weakness that we're seeing and therefore sticking the landing, making sure that economies avoid full-blown recession. But that's because they can see it more clearly emerging. The downside of the supply shock continues to depress prospects. And so their only counter to it is the only tool that they have in their toolbox, and that is to lower interest rates, which we've seen this in cycles past. And again, Canada and the U.S. Federal Reserve rates are in lockstep most of the time. They don't work in either place because it's global factors in both. Even in its monetary policy report, which accompanied the Bank of Canada's vote and its decision today, it notes that growth in domestic demand is estimated to have eased in the third quarter, reflecting slower growth in business investment and government spending. In contrast, growth in exports is estimated to have picked up, but that's not going to last. That's already rolled over. The available data suggests that consumption growth was about 1.75% in the third quarter, broadly in line with the first half of the year, but on a per-person basis, consumer spending is estimated to have continued to decline, which means that consumers are under pressure in Canada as they are everywhere else, global factors. This weakness in spending per person is likely due to the restrictive impact of past increases in interest rates. No, not so much. And the big one here, the real one, the soft labor market. For example, youths who typically spend a greater share of their income on consumptions than most other Canadians, have experienced a larger increase in unemployment than other age groups as the labor market has slowed. Therefore, as the labor market continues to slow, employment growth has been modest, less than modest, especially lately, and the labor force continues to expand due to population growth. The job finding rate has gone down as businesses' hiring intentions remain muted. Well, they say muted, but it's really getting pretty grim. And it's causing especially younger Canadians to pull back on spending because they can't find jobs. And since they're the group, the cohort that spends the most, it has this chilling effect all throughout the economy, even though there are not mass layoffs in Canada like there aren't in the US or other places around the world outside the auto business anyway. And with their CPI already below target, they're already seeing these warning signs pile up over and over again. Hiring, consumer price rates that are bad disinflation, and the global outlook that continues to become more uncertain, quote unquote. So of course the Bank of Canada is more aggressively cutting rates because they don't know what else they can do. They see that there's a possibility and a growing possibility of going way beyond Goldilocks into and past the danger zone. Understanding what all these central banks are doing and why, that's what Eurodollar University is here for, to cover all of the stuff that mainstream economics won't. We still have our fall sale ongoing, but it's winding down. The best prices that we've got on all our products, the daily briefing, the daily deep dive analysis, and our Eurodollar University memberships. Got incredible discounts on all of it. And if you want to know how the monetary system works, how it affects the global economy, why it's a global economy, our subscriptions have got you covered. The details about everything, including the huge savings that we're offering in the fall sale, can be found for a limited time more at our website, eurodollar.university. So let's switch gears from Canada, take a step back and look at this more globally. Now, Canada, again, remember, Canada, the US, Europe, all the developed world, it's really just a single global economy with some small variations between them. So consumer prices in the US, they look a lot like what we're seeing in Canada. Therefore, interest rate policy from the Bank of Canada looks a lot like the interest rate policy from the Federal Reserve or the ECB with, again, small variations. So if the Bank of Canada is more aggressively cutting rates, the chances that the Fed won't are very limited. And the reason why, because of what the IMF is reporting in its World Economic Outlook for the month of October 2024. They update these every 6 months or so. According to Bloomberg's write-up of it, the latest one, the International Monetary Fund lowered its global growth forecast for next year and warned of accelerating risks from wars to trade protectionism, even as it credited central banks for taming inflation without sending nations into recession. And that's a very premature celebration, as all these rate cuts and accelerating rate cuts are showing. Now, in the IMF WEO, they downgraded a lot of different places. They upgraded the United States based on recent economic data, which I think they're going to regret. But their biggest downgrades were reserved for Europe, which Germany and the central part of Europe, the auto business being a big problem. They also downgraded China too, which is another big topic that spills over into everything else. And we have to keep in mind that the IMF has downgraded its forecast continuously over the last couple of years, as I'll go over in just a moment. And the reason it has is because they didn't see the supply shock coming, the downside of the supply shock coming, just like they didn't see the 2008 crisis and its aftermath coming either. They're not understanding, not picking up on, or at least they weren't, that what this was actually going to mean, that the economic growth that appeared in 2021 was so artificial and therefore, transitory, that it wasn't going to continue on after 2021 moving forward. So they expected that eventually the economy would close the gap to where it had been before the 2020 pandemic erupted, when instead they're now seeing that economic growth all over the world continues to fall further behind. That's what the downside of the supply shock really means. Coming down from the artificial high in 2021 back toward something more like the 2010s, and that's not good news. As the WEO says, the World Economic Outlook, these various downgrades that they've been making to places like Europe and also Africa and the Middle East, these have been compensated for by upgrades to the IMF's forecast for, say, emerging Asia, where surging demand for semiconductors and electronics, driven by significant investments in artificial intelligence, has bolstered growth. And that's not necessarily a good thing, which means that all of the negatives that are piling up around the world are offset in part by the AI bubble, which is an unstable foundation, to say the least. And that's one reason why, continuing with the WEO, risks to the global outlook are tilted to the downside amid elevated policy uncertainty. It's not really policy uncertainty. They keep calling it uncertainty. They keep trying to tie it to central banks when it is really just the downside of the supply shock. Sudden eruptions in financial market volatility, as experienced in early August, which was tied to the U.S. recession risk, the yen carry trade, and everything else we talked about then, could tighten financial conditions and weigh on investment and growth, especially in developing economies in which large near-term external financing needs may trigger capital outflows and debt distress. And they also mentioned China, too, that there's risk to the Chinese economy because of everything that's happened in China. And they're relatively positive about, the IMF is, about the stimulus plans and efforts that the Chinese government are undertaking. But we have to keep in mind, too, that the IMF was also super positive back in 2023 over reopening. In their April 2023 WEO, they wrote, China is rebounding strongly following the reopening of its economy. The Chinese authorities have responded with a variety of measures, including additional monetary easing, tax relief for firms, new vaccination targets, because that was about the pandemic, measures to encourage the completion and delivery of unfinished real estate projects. With China absorbing about a quarter of exports from Asia and between 5 to 10% of other geographic regions, the reopening in 2023 and growth of its economy will likely generate positive spillovers. Spoiler alert, they didn't. And there's a lesson here. The IMF, like any other econometric projections, depends heavily on monetary, what they call monetary, it's really interest rate policies, and fiscal approaches. In other words, even as the IMF is continuously downgrading its forecasts over the last couple of years, it is still holding them largely steady and only slowly downgrading them because it continues to hope that these government measures like reopening in China or all the stimulus plans in China to rescue the real estate, or now the rate cuts coming out of central banks, they continue to believe that those will work when all the evidence continues to show that they don't work. That they have to keep pushing the projections lower and lower because they don't. The supply shock and this downside swing in the cycle are what is driving everything. That's basically the theme in everything from any econometric approach, whether it be the Bank of Canada, the Federal Reserve, or the IMF and its WEO projections. They're always wildly optimistic. They forecast temporary changes as permanent ones, like the one in 2021. They don't see the weakness coming because they don't believe that the economy can be weak or that central banks can be so ineffective and powerless. When you step back and look at the longer term picture, what you see is that when you plot the world GDP in US dollar terms, as of the latest numbers, the entire world is about, hold on to your hats here, $60 trillion in GDP behind the 1982 to 2007 baseline. It doesn't really matter what baseline you pick either. The numbers get to be so incredibly huge because of the silent depression. It all broke down in 2008. And it's gotten worse in the 2020s. As of 2019, before the pandemic erupted, the gap between world GDP and that pre-crisis, pre-2008 baseline was only 40 trillion. So it's gone from 40 trillion in 2019 to 60 trillion by 2023, in part because the recovery that they all assumed in 2021 was not an actual recovery. And we keep falling further and further behind as the years roll by, and everyone just accepts it. They all call it a booming economy. And they wonder why we're getting hit with wave after wave of the Great Migration. The so-called Global South has been absolutely pummeled by all this, and it's getting even worse. As bad as it is in the developed world, much of the problems that we're seeing in whether it be GDP or any other macroeconomic accounts really go double for emerging market and really places that have been hammered hard for the last 15, 16 years. And the primary weak point has been global trade, the private economy that all of this quote unquote stimulus is meant to try to offset, but it never actually does. And it goes right back like world GDP to 2008, which you can absolutely see on all of these charts. And that would make it one massive, gigantic historical coincidence if it wasn't about the 2008 crisis that explains the big changes here. It's not just coincidence that everything seemed to work really well, a period of unparalleled prosperity while the Eurodollar was functioning at its best in the 1980s and 1990s and part of the 2000s. And then all of a sudden the Eurodollar breaks down. We have a global monetary panic. And on the other side of that panic, the global economic system does not function in the way it did before. That is not just random coincidence. But that's why they keep trying to sell you on subprime mortgages. That 2008 was just subprime mortgages. We fixed all that. Bunch of QE money printing onward and upward into a boom when it's been the opposite direction. It never fixed anything. QEs didn't work, which is why they keep having to do them. Instead of onward and upward, it's sideways to lower. And then more recently, as I mentioned, the IMF has had to downgrade its forecast from the October 2021 WEO, which was in the thick of the red-hot economy, as Warren Buffett called it at the time. Everybody thought that it was a permanent plateau of prosperity, that they had come out the other side of the pandemic and the lockdowns even better than they went into them. The idea that the 2010s had been finally put behind because of the genius government plans that were implemented all around the world. They overestimated the economy, buying that price illusion and the temporary stimulus as some kind of platform for legitimate recovery. So they didn't see the break in 2022 and 2023 coming, that those were not going to get the world back on track. And in fact, what we're seeing from both of those years into 2024 and beyond is instead the downside of the supply shock, pointing the entire global economy, especially in trade terms, toward more like the 2010s than not. But here's the thing. Now even these reduced forecasts that have a lower trajectory, they depend on the continued growth of the AI bubble plus central banks lowering their rates in order to stick it. In other words, to keep the lowered trend still somewhat positive. And we know that's not going to happen. Lower interest rates don't do anything in the real economy. And what happens when, if or when, the current AI bubble actually pops? And I don't mean in the stock market. When the investment boom slows down and rolls over, as it inevitably will. So interest rate cuts and the AI bubble are the only reasons why the IMF isn't downgrading their forecast even more when we get all the signs all across the economy which say that that's where everything is pointing, including the Bank of Canada and its 50 basis point rate cuts. They know, they can sense it's moving in the wrong direction. That it's not just a risk, it's not just a trivial risk, it is a substantial reality. Huge thanks to Mike Green and Eric Basmajian for joining me yesterday for that live Q&A. If you want to see the replay of it, that's what I've got linked below. We talked about a bank cash crunch, as well as interest rates and Fed regrets and a whole bunch of other things. Thank you very much for joining me here. Huge thank you, Eurodollar University members and subscribers. Check out our fall sale. Final few days at that. And until next time, take care.